Welcome to Founders Club, the show for real estate entrepreneurs.
Welcome to another episode of Founders Club. Today I'm out here in Las Vegas interviewing Sal Buscemi, one of the co-founders of Dandrew Capital Partners. We're going to be talking about this 166,000 square foot industrial development that he's got going on out here. He's going to be talking about how he found it, how he funded it, his exit strategy.
When you're doing any sort of analysis on anyone, you really got to look at it as if you are a jilted ex-lover going through the cell phone records of your ex. And when you look at it that way, then you know that you've covered everything.
And all sorts of great tips on raising money from private investors. Looking forward to getting started.
Well, first off, cheers.
Cheers to you, yes.
Yeah,
enjoy the beer. I got a long day. Thank you.
So I'm enjoying an 805 today, and Sal's enjoying a Smart Water. And we're here on site at his beautiful construction project. And we're going to be kind of dissecting everything and talking about how you put this thing together. But why don't we just start by kind of giving an overview of the whole project?
Sure. So this is 166,000 square feet of Class A prime industrial. It has show space. If you see where we are, where I remember I was telling you, meet me at the Pepsi distributor. Yeah. If you look at the location of this property, it doesn't get any better. Vegas has traditionally always been a very transient neighborhood, a very transient low-wage jobs comes in for a hotel, gaming, so on and so forth. But over the years, Vegas has become a lot more cosmopolitan and it's become a lot more sophisticated. You have the Golden Knights, which is just absolutely amazing. You have the Raiders coming in. So naturally, there's going to be a lot of ancillary services that are coming into this place. We really put a lot of work into this. We're very choosy about the deals we go into, and we're very choosy with the partners who we go into as well. But finding these opportunities are very important because this is the type of opportunity that a lot of investors would gravitate to. The reason for this is because you're dealing with credit-worthy tenants, right? So if you look at this, you have Milwaukee Tool. They are a company with a balance sheet. You don't have to worry about them not having a job tomorrow. Right. Whereas you're not sure if somebody who's working two jobs, putting things together, if he's going to have a job tomorrow or not. So a lot of people and a lot of our investors who we call family offices who are 100 million minimum assets under management or more. And these are people who have sold businesses and they come into a lot of money. They want to put it into these things. But, there's a lot more to it than that. And I'm sure you have many, many different questions. And I'm
I do.
I saw what was on the Facebooks, on the Twitters and everything. So fire away.
Very
Good
cool.
to see you, though. Thanks for coming.
I
appreciate it. Better you than Sam. You look better than Sam, actually.
Thank you.
You look
Don't
like you've lost
Sam.
more weight than Sam. Don't tell Sam that, though, right? Yeah, no. Sam's good.
166,000 square feet.
Class A.
Class A. 4 different buildings.
Correct. Very modular. Location, of course. But there's also other things that I like about this, which are like the high ceilings and, you have the corrugation over here. It's modular. You can move in and out of it. And that's
so the plan in here is to make it very plug and play to where if someone wants half or they want just one little slice.
Exactly.
And everybody gets one of the big roll-up doors and they get some store frontage if they want it or need it.
If they want that. I mean, this is a premium, right? Yep. Not everybody's going to need store frontage. Not everybody's going to be Boyd Gaming showcasing their new products and stuff. This is where the stuff happens over here.
So I want to get into more about why you chose to do it that way, and I think we'll get into that in a minute. Here. But
in this very hot, sweaty studio that we're in.
Yeah, we're working hard. We're in Vegas. There's no air conditioning. We're on a construction site. Sal's sitting on a bucket, and we're gonna have some fun.
Yes, we are. I love this.
So tell me about your background. You worked at Goldman Sachs.
Correct.
So that was that your springboard into raising money?
It is. And people are like, well, I can see how that works and, I'm not like them. Well, hold on a second. I started out in college, I was a biology and chemistry minor, and I thought I wanted to become a surgeon. And I'll tell you what, it was the best decision I did not do was going into that. And I wound up on Wall Street. Working at Goldman Sachs. And it was very difficult today to get a job there, but it was even more difficult back then before social media and the legendary interviews and all this stuff. If you guys really want to know what it was like to work on Wall Street during that time, there's a book called Monkey Business, Swinging Through the Wall Street Jungle. And it's hilarious. It's not politically correct, but it talks about all this stuff. And, now everybody sees billions and it's all so glamorized and everything, which is great. But I started out there and I built networks. And you and I have known each other for a while. Sam too, there's networks. We have great networks. I have great networks in New York. But I also have a good reputation too with being a good asset allocator for these families, putting them into these deals. So they're looking for the best possible deals they can, risk adjusted, meaning they're not looking for a 10 or a 12 because they know there's going to be a lot of risk with it, but they just want something that they don't have to worry about for the next 7 years. Okay, maybe in the next 14 years. Right. And that's the way we engineer these deals. Safe, solid,
predictable.
Exactly. And so it's like, okay, this is trust fund money. This is what wealthy people invest in. And, if you have, like, for example, like some of the families, they sold a fence company for $60 million. What are they going to do with it? They're looking for the best possible assets to put that into so they don't have to worry about things. Because if you think about it, the wealth creator has busted his butt so long to get to the point where he has $60 million. Now what is he going to do? Capital today is more of a commodity, and you have to treat it as such. And I've told you and Sam that many times, is that there's a lot of people that have money out there and it's looking for a space, but you have to actually know where to find the right deals to get into. And that requires, as you know, networking.
Tell me a little bit more about the journey to getting here. So you were at Goldman for how many years?
This is great. So I was there for 5 years. I started out in the equity capital markets group in the investment banking division. Okay. And I actually befriended the partner who worked in what we call the real estate principal investment arena. And he said, look, if you want to learn how to go from driving a rocket ship to a Greyhound bus, come over to the real estate side. And I actually fell in love with it, and I'll tell you why. It's a little slower, okay? But it was great because there's a lot more money that is earmarked, or it's a lot easier to raise capital for real estate deals than anything else. I also like it because we did a lot of distressed work when I was there. Distressed work meaning people overpaid for stuff. How do you help them? Working with things, maybe your viewers have heard of these things such as capital structure, mezzanine, we're talking about preferred equity. That's what I sort of specialized in. And then after that, I was a hired gun for a Chinese family office in New York. Okay. And I was basically, I wasn't operations, but I was more business development, and they wanted to get an apartment building on East 87th and 1st during the condoization boom of 2006 and 7. I won that, and then I've had some personal issues too. My father passed away when I was at Goldman. At that point, I made a promise to myself I was going to swing for the fences. And in 2007, after 40 institutions slammed the door in my face, I finally got one institution to give me $30 million. And we basically became the kitchen sink for Bear Stearns. And we were buying all their distressed whole loans. And then I did what all smart people do after that and just continued to move on. And I came out here because we bought a special servicer for $1. And this servicer was servicing bad hard money loans against commercial real estate. So I've done 2 credit funds, 2 distressed credit funds. And since then, we've leveraged those relationships with the families who have invested with us. And we've gone back and invested into them into what we call more private equity venture stuff and had a lot of success with that. And we really like it because it feels good because you're actually investing in something that you know that is affecting people's livelihoods. And one of the things I always worry about is I always want to make sure people understand what they're investing into. And just because it's real estate doesn't necessarily mean they're going to come, right? The tenants are going to come. You have to have a real good team and a real tight network to pull something like this together. Right. But when I started at Goldman, I really understood how the world of finance works, and it's basically raising capital and putting it into these types of assets, which is going to be paying a lot of reoccurring revenue, not just to you, but to your investors as well. Because you don't want to destroy their life savings. Yeah. Right? People work very hard. Life savings to me is stored labor after work. It's stored labor after tax. Yeah. So when you retire, you've already paid taxes on all this stuff. The government's already taken it. I'm just make sure that it's preserved and it's growing, in the commercial real estate space. People want to get more aggressive. We move into other things, GP interests and credit funds and stuff like that.
Project isn't done yet. Right. But you already have Milwaukee Jewels as a tenant.
We have this pre-leased. I don't know if I can really talk about this, but we went in underwriting this at $1 per square foot that we would lease it at. Yep. And if anything more than that would just be great, gravy, right? We're at between $1.25 and $1.40 per square foot, and the leases are coming in 125% faster.
Wow.
Yes. So we're happy. The most thing that's important to me is the credit worthiness of the tenants in here. So we purposely know what our investors want, and we club in with them, and it has been a tremendous experience so far. And we have some rules that we follow, and we can get into that. But this is the way the world's going today. We're in a very low interest rate world, and you have to be extra careful. That does not give you the right to overpay.
Yeah, exactly.
That's my rule.
So how are you pre-leasing these? How are you marketing it? Are you marketing it as It's a shell built to suit?
No. It's being sold by the commercial leasors who have the relationships. I'm not doing any of that stuff.
Got it.
So they're going out there, and that was all
So the
planned.
brokers just handle that for you?
They handle it for you.
Yo, was this dirt when you bought it?
No.
Or-
So this is what we call a joint venture.
Okay.
And so this is a family who has been building all over the Southwest for a while. They're located in California. Very, very good reputation. Okay. And they approached us because we're capital providers. We're allocators for family offices. So if I'm managing your money, we use different structures, and really the 3 boxes we look at when we get into these things are as follows. Number 1, I want to see if the operator's doing any of the stuff, that they have an audited track record. If your track record's so good, why didn't you pay someone to audit it, right? Mm-hmm. You want to be able to see that. A lot of people don't do that right now. A real development management company is going to have that, right? Number 2, and this is something that a lot of people get rubbed the wrong way, I want to make sure that these operators and developers have been through at least 2 cycles, okay? So that means 1999 and 2008. 2008 was really just Darwinism for people who are financially stupid, right? I mean, when I was out here, gym coaches in San Diego were buying sight unseen 3 investment properties in Las Vegas, and they were paying nothing for it. They were basically not using any of their money. They were getting 105% loan to value. Loans back in. That all just wiped out. So we want to work with people who have been through this. They got the scars on their back, which leads me to the third thing is depth of pockets. We want to make sure that we have people who are working with these developers that have at least 10% hard equity in the game. That's not market equity like I bought it for this and now it's worth this. No, that means they're putting their money into it, and I want to make sure that they're not sort of pinching between the pillows and the couch to make sure that they can actually, that they're actually well funded. I think a lot of people, especially in what we call value-added deals, rehab deals, they get into it, there's expense overruns, they don't know what they're doing, they overpaid for it, they're over-levered, and that's where the problems come in. So we do that, and when you pay attention to those 3 rules, you can sort of go to bed at night figuring, okay, there's a good chance I'm not going to lose anything because you're working with the best in class that you can find. And of course, there's all sorts of other background checks and things that you do with that. But going forward, once you get to that part, then you have something to work with. And that's something that you might want to look at as far as channeling energy, direction, time, and resources into co-investing.
And so those 3 rules were audited track record.
Audited. Not
2
from some guy
cycles.
in a strip mall. 2 cycles.
Yep.
And 10% equity, hard equity in the game.
10% hard equity. Cash.
Okay?
Okay.
And even then, I want to know where that cash comes from.
Yeah.
Because there's people out there, and it's very popular today, especially in multifamily. And again, Sam's not going to like that I'm saying this. But a lot of people go out there, and they're like, oh, well, this person's putting in 10%. But where's that money coming from? You're married, right?
Yeah.
You don't want to lose your mother-in-law's money, right?
Right.
So that's aligned capital, right? So if you said to me, well, half of it's mine, but I got some money from my mother-in-law, that's fine. But if you're going out there and you're syndicating it from people who you never met on Facebook, you have absolutely, your heart isn't in it. And if anything goes wrong, you can just walk away, and those people are going to be sandbagged
left holding
with it.
the bag, yeah.
They'll be left holding the bag. And it's like, well, so that's why we want, it keeps hearts and minds together, Oliver, right? It keeps hearts and minds together. And that's why we ask the hard questions to make sure, where's this equity coming from? Oh, you're putting in 20%? Well, what does that 20% really mean? Well, it's from a bunch of people who I met on Facebook in a group. And then, I also, there's market equity because this is what it's going to be worth afterwards. Well, you're buying off it today, not tomorrow. So that's the rules that we play by. And again, you're adding unnecessary risk if you violate any of those rules.
I like those 3 rules.
It goes with apartments, industrial, retail. I don't care where. I don't care what it is.
Can you speak on that audited track record, how that works? That's actually, I've never heard of
Usually
that.
somebody will pay about $4,000 to $5,000 to have a firm audit their financials and track record.
Got it.
Which shows them exactly, this is what I got in at, this is what I got out at, this is what the investors got.
So that's different from like an accounting financial audit.
No, it is.
Okay,
it
got
is.
it. Got it.
You want to make sure that what they're saying, the numbers are correct, because there are more lies told through an Excel spreadsheet than all of Word documents and books put together.
Yeah.
Remember that. There are. I can make the number, I can dazzle you with numbers.
You can massage it all day.
Yeah, it's all ledger domain. It's all people like, oh, we'll do this. And I see that now. And that's why I'm very, as a PSA, and thankfully I'm I mean, I'm glad to be on this podcast. We've been talking about it for a while, but I think now we're at a seminal point because a lot of people feel as though they have to get into multifamily or they need to get into real estate because prices are going up, and they don't understand what's driving the prices going up. And I just want to make sure that people really have a fundamental understanding is that if you're writing a check, whether it's from your retirement account, somebody else's retirement account, your savings, whatever, if you're following the 3 rules, you're probably not going to get hurt.
Yeah.
And that's something I learned at Goldman. A bunch of other things. Like the money always has a voice, right? But more money has a louder voice and all that kind of stuff.
Totally.
But the way I look at it is operator selection is the most important part to me. Operator and the numbers. And I want to make sure I understand the numbers. And that's why we're pleasantly surprised that we're getting $1.25, $1.40 a square foot.
When you ran the deal on $1.
Yeah, on $1. So to me, it's like, great, because that means my incentives go up and the investors are happy and they're going to be much more amenable to opening their wallet for other types of situations. And that's the most important part. There's a lot of brain damage that goes into this. And if you don't know what you're looking at, you should ask for help. So we're sort of a boutique level. We're not a Goldman Sachs, but we're a boutique level. But that's enough for them to say, okay, well, we worked with this company. Everything went very well with them. Now we can move on and do other things. There's other things as far as the negotiations concerned too, that you bring it up. But as far as that, it's usually what we'll do is we'll offer a term sheet. They'll send us a term sheet. We'll go back and forth. But the one thing that was very important to me and why we like working with established operators is because they have experience and they know what can go wrong. And a great example of this to me, for example, would be what I call the put call, the put call. So what does that mean? That means that there's going to be a put. So in 7 years, most of these, they have like what they call a buyout option, okay? So the buyout option comes and they say, okay, so in 7 years, we're gonna buy you out. Okay, so who determines the value of that?
Right.
So usually what you see and you hear is like a partnership blow up and they'll say, well, Oliver, is going to offer me $20 million for this, but it's really worth $40 million. And I'm going to say, well, okay, if that's the case, then I have the right to buy you out at $20 million. Now all of a sudden, it makes the conversation a lot more serious.
Right.
You see what I mean?
Yeah.
So it's and it's the experience that you have to have in order to do that to get to where you need to be. But getting to your point, and I know I talked to Sam about this and you a couple times when I'm in California, is you always, okay, you're in the deal, you're getting cash flow, but what happens afterwards? Right? What happens afterwards? And that's the most important thing that you need to understand is, okay, how do we break up? And that's called a partnership agreement. And that's what you talk about. And a partnership agreement is no different than a prenup.
Yeah, exactly.
That's what we call it. It's more expensive. It's a little thicker, but it says, okay, if this, then that, if this, then that, and how everything is going to be handled and who's responsible for what. Right. A lot of people, a lot of novice investors get into this business. They don't have it's like, hey, I just met you at a seminar.
Right.
Hey, why don't we become partners?
You seem like a great guy, so let's do something.
You seem like a great guy. Let's do something. Right, and you don't know anything about him, and you have all your reputation at risk. I've talked to people about this, and I've warned them away from people. But a real partnership is like a marriage, and that's the way it is. You either share a checking account, a bed, or both.
I love that.
So if you're not sharing a bed or a checking account with someone, you're not partners, right? Totally. Because the only way to open up a joint bank account, if you're not married, is to have a partnership agreement, with an LLC, and, that kind of stuff.
And the other part, which I think is huge, to your point, is outlining, should there be a breakup, how it's going to work in
Nobody
advance.
thinks about that. People are going into deals today in multifamily, and they're just like, this is great because there's a lot of hype. I've seen a lot of bad things happen. There's only so much I can do, right? And that really becomes, an issue at that point. But people need to really understand, hey, what does this look like at the end? What happens in 7 years? Are you going to wait 7 years from now or what? Mm-hmm. And that's why, part of the negotiation is, what does it look like? How are my investors, let me say that again. How do I show my investors that I have their best interest with them first?
Right.
Because I come from the school of Goldman Sachs. If anything goes wrong, you scorch the earth, and you don't want to do that, but you don't get into that point if you are working, again, with the 3 rules that I talked about, competent operators who have done this, who've been through this before, have other properties like this. This is not something new. We're not paying for tuition here, right? And I think a lot of people, a lot of investors today going into multifamily are paying tuition.
Yeah.
And I think that's not investing. And these are the hard questions, unfortunately, that you and I have talked about, but your family here should know that, hey, you got to always look at the end game too as well. Exactly. Not just, and also I want to know what that end game looks like. Is it a sale? or is it a refinance? Because a lot of the investors we have are longer term money. They're going to want to keep it and let it go.
Yeah.
Okay. Short term investors, usually poorer investors, not accredited investors, they just want the money in and out and they don't really understand that. So it really takes understanding what your investors want and keeping to those promises so that they understand, hey, this is the best. We have your best interest at heart. So when you're communicating the deal, you can say in 7 years, there's a putback. If you want out, that's fine. There's a liquidity event. If not, you're going to get liquidity anyway. It's going to be tax advantage because it's going to be a refinance, right? The commercial real estate grand slam.
Yep.
And then you get all that money back and then you can reinvest it into other things.
Right.
But the opportunity zones, though, today are interesting to me because I think that's given people a license to overpay for some stuff, and we don't want that to happen. Mm-hmm. So you got to be careful. You got to know your basis. What are you getting in at? What does the comps look like? You got to look at, when you're doing your comps or you're doing any sort of analysis on anyone, you really got to look at it as if you are a jilted ex-lover going through the cell phone records of your ex.
Damn, that's good.
And when you look at it that way, then you know that you've covered everything.
Yeah.
If you're not asking the hard questions, you don't. But think about it. We've all had crazy exes. They've all done stuff, like show me your phone and everything. Or burden of proof is on them. You keep asking for the questions. If things don't feel right, do the gut check. If the gut says no, get out. And that's it.
What sort of advice do you have on like vetting these types of deals?
I would always compare to what you're doing today versus what the market's doing. You really want to make sure that you're getting in at a cap rate that you'd be able to get out of. I'm going to tell a story here, if I may. So we gave back $19 million in 2013. And what we were going to do at the time was buy what's called a lot of broadline necessity retail. These are things in parts of middle America called Alcos. Shopko's not one of them, and Pamida. Shopko has a very bad balance sheet. And these things had been trading at between a 9 and 10 cap, going all the way back to Moses, okay? Until some dentist with a signature loan bought one for a 6.5 cap. And if you know anything about cap rates, you want to buy a high cap rate and sell at a low cap rate because that's inverse to the value. What happened here is this dentist who didn't know anything made a market according to the REIT that was selling it and the broker that was involved. And we had $19 million in equity to buy from this triple net lease, what we call necessity retail. This is where people go. You're never going to have a drone service in these parts of the country. Actually, AJ, my COO, owns 2 of these things, so we know the asset very well, but he overpaid for it. And I said to myself, I'm going to give the money back. Because if anything went wrong, and they will, I'm not going to be able to sell that at a 6 cap ever again. They're going to want like an 11 or a 12. So that's why we backed out of it. You always need to know how you're valuing these assets before you get into it. Mm-hmm. That's the first thing, because even the best operators in the world are not able sometimes to get out of an over-leveraged, overpaid property.
Yeah.
And that's where you're going to see a lot of problems happen today in commercial, especially in multifamily, especially in C-class, what we call, and this is, I know I'm going to get a lot of hate on this, but it's going to be a lot of the Class C stuff that people bought at a 5.5 cap. And, we can get into value-added stuff in a second, but this is what's going to happen. And that's going to be really an issue with the smaller balance stuff, say between 10 million and less. Mm-hmm. People overpaid. If AJ, for example, my COO, he is a real estate investor. He sold his multifamily for a price he never thought he was going to be able to get for it.
Yeah.
From a guy who has no idea what the hell he's doing.
Who just wanted to get in because it's hot.
Because it's hot and it's going to go up further. The problem with this is that what drives value of commercial is rental income.
Right.
Nothing else. And a lot of reasons why people like and they gravitate towards something like this is because they know that the consumer's already tapped out, right? So if you look at it from an economic standpoint, me being from New York City, living in New York, renting in New York, owning in New York, you spend about 50% of your after-tax salary on housing. The rest you spend on shoes, food, and lifestyle. Right. And once that becomes more than 50%, you can't hike it anymore because now it's like, well, you know what, screw this, I'm gonna go across the street because that guy's gonna give me economic incentives. He also has a nicer, 2.5 horsepower Whirlpool bath for my wife. He's got a front desk, a newly paved parking lot. And I can get in there for $100 a month cheaper, so I'm just going to move out. And that's what you're going to see is, some sort of a migration, I think, when people who are weak, inexperienced operators think that they can just go in there and hike the rents. That's never been something. Also, the expense ratios on something like this, much lower. In multifamily, it's 45 to 50%, if you know what you're doing.
And why is it so much lower on these types of properties?
Because these things are really, they're built to, I mean, the tenant improvements have already been put into, they do it themselves for the most part.
Yeah.
So they come in, Milwaukee Tool knows what they want. There might be some T&I, but they're there for the 7 years, okay? So you're recapturing it back. But it's also sort of like at the time now where if they're coming in at this point, they're probably gonna be here forever, and that's actually a good thing for us. So the expenses are really, you're not really too worried about, there's no toilets here. There's no air conditioner, we know that very well, but there's no heating for each unit that you're responsible for because your tenants don't care to shut the windows and things are going on. There's just a lot of inefficiencies with multifamily that you don't get in other asset classes.
Yeah, that's interesting. That's a good point too.
I mean, you've heard the stories like guys flushing concrete down the toilet. I mean, that's a couple grand there, right? I mean, they're upset with the landlord, or they're smoking cigarettes and minus 20 degree weather with the heat on, with the windows open, and you see this all over the place. But it really comes down to the quality of the tenant that you have and what they do.
Interesting. So that's why you like the office as an investment.
I like multifamily at the right basis. I like workforce housing at the right basis, and that's not a 5 cap for CCAT. Okay. I like that much more to where it was traditionally trading at like north of an 8 back in the day. I think that's going to come through. I think there's going to be some distress in that area where you're going to see some people come in, and we've already starting to see some of those things. But getting back to your point, it's not just office. This isn't really office, this is industrial. But I like to have a very steady, credible tenant. Right. Okay. Think about it this way. If you were to go to bed at night, pulling the covers over your head, there's another earthquake, say, and you're worried about the end of the world, are you going to look at your wife and say, damn, I'm glad I have 200 deadbeat tenants who could never afford a house if they even tried to? Or, damn, I'm really glad I have publicly traded companies with balance sheets who pay every month and I don't have to worry about that.
Yeah.
How would you want to retire? Because everybody thinks just owning something means they're going to pay. It doesn't. That's what we call credit risk, right?
Yeah.
So were you going to trust your retirement on Joe Sixpack having a job tomorrow after he's gone through his second divorce and his kids hate him? Or are you going to bet your retirement on something where you might not get the same high return, but it's much more stable and much more longer duration, what we call. Okay. And that's what people want. They pull the covers over their head knowing, oh.
Yeah.
I mean, there's times I drive past this over here, come from the airport, I'll have like a bad day, but I'll pass by this and I'm like, life's not too bad anymore.
Yeah, exactly. So I want to go a little deeper on the money raising, because I feel like that's one thing that you're an expert in, and
I love it.
Have done a lot of.
Yes.
How much money total would you say that you've raised in your career? Ballpark.
450 million in equity for other people's projects, and for my projects, I had one fund that was 30. I had another one, the second one, which was a special situations, that was 15. That's all institutional money that's come in. With the retail money now and the stuff that's coming in with that, we're starting to see more money from retail people come in. So I'd say I'd be comfortable staying around close to $500 million.
Wow.
Yeah.
Yeah, that's a lot.
Since I've left Goldman, yeah.
So you're mainly working with family offices, right? Which is basically
sorry.
really wealthy people that
are
looking for ways to continue to make their money work.
They care about their legacy. They don't care about anything else but their legacy.
Okay.
They don't have to invest. They need to be kept busy, but they also want to know, hey, if I die, what is going to carry on my legacy? Okay. And that's what they're worried about. Is that you have the wealth creator, and then you have the second generation who's usually kind of into it, but the third generation usually loses everything. I call it the Greek diner roll. It's like this first generation comes, they're the wealth creators. The second generation, they support it. Third generation, it's like Paris Hilton, they just blow it away on yachts, parties, Ibiza and stuff. I've seen this, rich kids of Instagram, they get held hostage. There's ransom insurance that Lloyd puts out for these people. It's actually kind of interesting, how this...
Ransom insurance.
Ransom insurance, yes, because if your kids go out to Tijuana and they take selfies and everything, there's going to be a bandito that's going to kidnap them, and it happens a lot. Yeah. But we raise money because I like to do things, and when you raise money, I think people look at it from a standpoint and they say, well, they're looking for like a quick hit. They don't know what they're doing, and the last thing you want to do is to come into a family and say, hey, how you doing? By the way, I got this great deal. It's like asking for sex on the first date. You know what I mean? You never show up with 4 pounds of paper. You build a relationship. The first question I ask is, Tell me about your family. What happened? Because there's only one person who's more into that story than me, and that's you telling the story. Well,
let me tell you about that.
Trials and tribulations, and me, and then in Texas I was run out, and all who knows? I mean, there's always a story, and that's how you build familiarity, is by getting to know people, because they want to trust you. They don't want they don't want the mechanical, technical, sterile relationship where it's just an email with a PDF or something like that. They want follow up. When I'm raising capital, you've heard me talk about this, I always tranche it out. I always use deadlines. If you're not using deadlines, your deal's going to go stale. If you're not using tranches, your deal's going to go stale. Oh, really? Sal showed me this 4 months ago. Now why is he still doing it? Well, the first tranche went over. Now we're going on. You always have to keep it fresh. You have to have a story. When people communicate these deals, I tell the story of this, okay? The story is, this is a very prominent family. They have a lot going on. They have very deep pockets. They are very well respected. It gives them creature comfort, and it's like kind. Like, they're very wealthy. Right. They're investing. They're allowing us to invest alongside them. It's great. We're building what we call club deals. We're clubbing in together. Okay. You guys call them syndications when you have like many people with like $10,000 checks. This is what we call a club deal. Okay, I'm going to club in with these guys on this one, and I always put in some money, whether it's from my own or my late brother's estate, or my mom's estate. I'll tell them I'm putting in $100,000 of my own money, and they want to see that part of the conviction. Now, I can't afford to seed every deal that comes around, but they know when you're starting out, when you tell people, hey, this is how much I'm putting in, it shows that you have conviction. Money is always shows conviction.
Yes, and I totally agree with that. And I actually have a question around that. Is one, are you putting money in on every deal yourself?
Not all of them.
Because I'd imagine because you can't.
No, I can't.
Right.
But I will tell them that.
But so my question is, how do you present that? Because I'm sure a lot of investors are, their first question is, well, are you getting in on this deal?
They will. And these are investors who I've known for a while, but when you're starting out, you just tell them, this is the way I would do it. I said, look, we're building an investment business here. My equity is in the business and the relationships that we're doing. And we're getting to the point right now where we're able to co-invest alongside some of the most successful developers, best real estate, Class A, right here. This is a privilege. This is an opportunity. Here's the story behind it. This is why I am very, very convinced, or I have strong conviction in this, even though I don't have the money to put into it. I am going to perhaps maybe not take a management fee, or something like that. You can always incentivize people by showing like a quid pro quo. Like, for example, forget the management fee, or maybe lower your incentives, so that if it's your first deal, so that the investors feel like, okay, I like this, I totally understand this. Another way to do this too, if you wanted to, you could always set up your own, and this is getting a little deep here, and we talk about this in my ACPAR certification, but you can always set up like a GP-LP structure where you raise the money for the GP to put into, there's all sorts of ways that you can do it. You just have to be creative, and you have to be upfront and honest. And when people start doing things where they start shuffling things around, you can't get the right answer, like, yeah, I'm putting money. Well, I mean, what do you do? Well, I'm recycling my fees. And, well, that's not really, it's not,
exactly.
I want to know, where's this coming from? And when I tell people it's coming from my mom, they know that she's in an assisted living facility that, has a burn rate of around $6,500 a month. In New York, before we moved her out here, it was $9,200 a month. So I invest in these things to pay for that stuff, right? That's for me. And they understand that, but you have to have a good, credible story. And when you're starting out, you don't want to do this yourself. You don't want to be the operator. Find the best deals, raise money around it, build your track record that way, and continue to move on. Very simple.
Great. Yeah.
A lot of these people, these hardos, come out, they're like, yeah, I'm going to buy a multifamily. I'm going to fix it myself. I'm going to do it. Why? Life's too short.
Yeah.
Life's too short, and it's just, I like this model. This is the banking model. This is, the merchant banks have done this for years, and this is just the way it works. And you don't have to worry about so much other things too, where, you can choose the investors you want to work with. And the networking amongst those investors are just amazing, because you're with one firm, one family, here's another one, here's another one, here's another one. After I see you next week in California, I'll be in Chicago talking to a bunch of other families who are sitting on a lot of cash, and they want to know what are the things that, Sal is looking at that's going into it. I would say always talk to your investors, but always seed them first. I wouldn't say, hey, I'm like, yeah, we're doing a lot of different, everybody's going into multifamily today. We're actually going to move into something else because The numbers make sense, but from a longevity standpoint and duration standpoint, a lot of the wealthy families that we manage money for really are looking into this. Maybe that's something you should look into. See?
Yeah. That's a good little
Rather than
seed
coming
plant
up with,
right there.
Yeah,
with
exactly.
the deal sheet. Yeah.
Yeah, with the deal, and the deal sheet should never be more than 3 pages. And you've seen them. But like, compared to a guy that comes, he's like, all right, I got something.
Here's
I
your
don't want to
deal.
see that.
Right.
I don't know you from Adam. I don't know anything about you. People want relationships today. We call this indoctrination. I spend a disproportionate amount of time writing letters to investors so that they understand my viewpoint and how I want to look at the world. And either you agree or you don't. You either agree or you don't.
Right.
If you don't agree, don't invest.
Right.
Go to the other guy that's paying for a 4.5 cap for a Class C, in Georgia that he's never going to get out of. It's not me.
So, okay. So for the people that are looking to get started with raising money, they're probably not going to be talking to family offices.
No, they're
right?
not. I think they need to talk to people who they know and trust. For example, when I first started doing deals, the first $5 million I raised after I left Goldman was raised in the men's locker room at the New York Health and Racquet Club on Whitehall Street in New York City. Now, that sounds kind of shady, doesn't it? But these are guys that had watched me grow up on Wall Street. It was kind of like a big chest-pumping thing to me when a lot of my coworkers at Goldman invested in me. And I went, and we're doing this now through our mentoring is, there's always going to be friends and family, but if you talk to the friends correctly and you tell them what you're doing and you keep going, you keep following the narrative because everything's a narrative, much like what Sam does every day with his video stuff. That's how you build a following. That's how you build trust.
Yeah.
And the best way to do this is not just to put out a pitch book, but just to talk. What do you think about the markets? Yeah, I think rates are going to go down before they go up. That's me. I can justify that and talk on a podcast about that. However, that is what differentiates you from everybody else. What are you investing in these days? I don't know. The market, the election coming up. I don't know. And the other thing, too, is that one of the things, the bogeyman or the 800-pound gorilla in the office that you need to consider here is that everybody's scared of real estate at one point, and they won't tell you why, but they don't like the illiquidity part of it.
Right.
Okay? Liquidity, to me, is a very expensive convenience for you to make emotional mistakes with. It is, they're liquid. Do you think the family that owns this cares about liquidity?
Right,
If the
not
stock
at all.
market
Yeah.
drops 50% tomorrow, this is still standing. Milwaukee Tool will still be here, or whoever it is will still be here. Okay.
Yep.
If the stock market drops, I think a lot of retail investors are unsophisticated, so they don't understand it because they're thinking, their thinking is that they were probably raised by Depression-era great-grandparents, grandparents, parents who have given them a very skewed view of the world as it relates to liquidity. Oh, well, it's not liquid. What's the liquid event? If you can't scrape up $40,000 or $20,000 or something like that, you shouldn't be in this game, right? If you need liquidity. But you can put liquidity preferences into deals like this to make yourself look like a rock star. That's a little advanced. We did that, 7 years from now. But you have to handle the big 800-pound gorilla in the room, not Sam. Got you, booby. But illiquidity, okay?
Yeah.
And say, look, this is illiquid. This is what wealthy people invest in. They don't care about liquidity.
Right.
Either you're sophisticated or I thought you were a little better than that.
That's good.
I thought you were a little better than that. Well, yeah, okay, all right. Well, liquidity. The other thing, too, is that you need to hold the story and hold it. Whenever you're raising money for real estate, you're going to come against people who are going to tell you that it is illegal to invest in real estate. Brokers, people who have incentives that are not aligned with yours. What do we mean by that? These are people who don't have an alignment of interest. If you call up Schwab and you sell shares of stock, they're making their percentage. You got your liquidity, but they got their percentage. If you buy the shares of stock, you pay another fee with that. And these people are going to be very protective, especially if you're going to start taking money from tax advantage accounts such as ERISA-based accounts, self-directed IRAs.
Yep.
Because those guys are going to fight like hell and tell your investors that what they're doing, there's no such thing as a self-directed IRA. There's no, and I actually have a book coming out. It's my third book. It's called The $100 Million IRA, and there's a picture of Mitt Romney on the cover of it. Because if he got away with it, everybody else can.
Yeah.
And it's really like private equity, commercial real estate strategies. Getting back to your point, you have to handle, talking to them about liquidity and understand their comfort with liquidity. And I think as an investor, one of the things you're going to be talking about is, well, okay, it's not liquid, it's for grown-ups.
Right. Yeah.
Okay, you want liquidity? Go
So you're
buy
really
a
pitching it
$60,000
as
house.
like a 5 to 10 year.
This is a 7-year.
7-year.
7 to 14.
Got it. And at the 7, there's going to be a refinance, which
Or a
will,
sale, yeah.
So people can get out if they want,
Correct, yes.
or they can let it ride and stick around.
And
with
I'll tell you right now, we did polling. You know, we know who the LPs are in this deal. Almost all of them want to just let it ride.
Yeah.
Because they don't think they're going to be around. There's a lot of these families, we call it generational events. You know, we're waiting for someone to die, right? That's, you know, in the family governance agreements. People who are attracted to these deals don't care about liquidity, they just care about cash flow, and they care about good basis.
Yeah.
And ostensibly, this is probably safer than keeping $1 million in an FDIC insured account anyway.
Well, yeah, no doubt about that. So, in terms of the money raising part,
Sure.
it's don't come in hot with a deal.
No.
Plant seeds.
Plant seeds, talk to people.
Have conversations.
I'll tell you, the smartest thing I ever did, I like to get onto charities, boards, where there's a lot of board wealthy people. And that's how you're able to build prominence and influence, is becoming like someone. I would go to meetings. We have people I know who, you know, they'll go to, affiliation type things. So if you are, say, Chinese American or something like that, you want to hang around those people.
Right.
That's people, the affinities help. If you're, of one demographic, one religion or something, that's something to start. But I started out by doing this by sitting on the board of managers of the Chinatown YMCA in New York, right? Because I was there originally to find a bride, because I networked with the president of with the president of the New York Stock Exchange at the time, who told me to call Paula. And I was in the real estate, dealing in real estate at the time, and said, well, there's two of them. There's Harlem and then there's Chinatown. And at that time in 1998, Bill Clinton just moved to Harlem, so they didn't need any help, right? But Chinatown was great, and I built a lot of great relationships down there too as well. And that's how actually I got some family office money from a Chinese family office that I worked for a little bit afterwards as a hired gun. And then they were the ones who seeded me on some other deals. And they would come in as well. Yeah.
And then what are you, just getting their contact information to...
Get their contact information. I treat them like friends. Okay. You know what I mean? So I have a friend who is very into boats. I love boats. And so I'll be like, hey, I'm at the boat show. Look at the, treat them like friends.
Right.
Okay? Don't treat them like ATMs. Treat them like, hey, you're coming to Vegas, let's meet up.
It's a big distinction.
It's a big distinction. Yeah. You know what I mean? Hey, you're coming to, there are investors I know who, I have a 2-door car, but I'll be like, hey, I'll pick you up at the airport. I'll grab 10 minutes with you, a coffee at the start. I have the whole, loop down, like here, in and out, and that's it. But you have to treat these investors not like they're just someone different. You got to treat them like friends, because that's what they really want, is the friendship and the level. And if you look at anyone who's been very successful in this business, is that they've all learned how to raise capital, number one. But number two, they've treated their investors not like ATMs, but they've treated them like real people. Mm-hmm. I mean, if I ask you for a check and it's the first time I meet you, are you going to be like, it's a good deal, but I don't know this guy?
Yes.
You want to get to know me a little bit, right? Okay.
And so what does that getting to know you process look like? Is it...
Today, it's be careful what you post on social media. People are judging you. Mm-hmm. I would say that. There's some people I know who there have been other operators who I know have been successful, but some of the things that they've done or showcased on social media, I don't really agree with, and I don't really know if I'm investing in the property or in someone's ego. Mm-hmm. And when you're investing in someone's ego, they will screw you every single time. Okay? I am judged by the car I drive. I know. Everybody's like, well, you're your own boss. No, that's not true. Mm-hmm. That's not true. I would not show up with a cherry red Porsche. Okay? If I was a plastic surgeon out here, who cares? It's expected. I probably wouldn't drive a Bentley. It's a little bit too conspicuous. And, from my days at Goldman, they always showed us wealth is meant to be saved, not shown. Okay, we always used to, I'm wearing a nice watch now, but we always wore Timex Ironmans. There's all sorts of stories in that cult and everything that I'm sure Michelle would love to hear. But the point is that people are judging you. And especially today on social media, they're judging who you're with, what you're doing, and that is what I like to do. I like to say, is this guy really real? For example, Sam, I think he does a great job. I've been checking him out for a while. I would invest in one of his deals if he was qualified, right? Mm-hmm. But somebody else who I didn't know, I'm looking at them, they're spending a lot of money, very conspicuous consumption. That's a red flag.
Yeah.
I don't like that. That goes against my rules. So I look at this and I say, okay, it's fine. But I know that there's some very wealthy guys who I pick up. They don't look wealthy, but they're going to be looking at the car and be like, what why are you driving a cherry red Porsche? You know, I'm not, but you want to look like you're doing well, but not too well.
Not too
because
well,
then
yeah.
people think that you're charging management fees for self-gratifying,
Right.
conspicuous consumption.
Right. Okay, so I like that.
I know a lot of people like that, and I know a lot of people are going to take issue with it, but that's the way the world turns.
I think that's just part of the reality is like people are judging you, and you know, in the Real Closers group, the what kind of car you drive conversation comes up a lot, and I think that to a certain extent it depends on where you're at, right? Like if you're selling rural farmland in Montana, you're not going to roll up in a new convertible Benz.
No, you're not.
But
no.
if you're selling in Beverly Hills
That's a
and
whole
you
different
roll
thing.
up in a beat up, you know,
Nobody's gonna take you
1996 Ford
Corolla.
F-150, then, you know, no one's going to take you seriously.
No, exactly, because
So-
people do judge it. They judge it. I mean, the joke in the industry is like, you know, I'm not going to plug my Instagram page, but we always talk about, you know, the deal sledge. You know what I mean? Like, you know, you don't want to, I can go, wait, I don't want to make fun of a lot of people, but, you know, it's like, you know, if you see a guy coming in and he's like a banker or he's like, you know, a guy like me or something and he's wearing rubber sole vibrant shoes that haven't been shined in 20 years and they're black and he's wearing a suit that doesn't fit right. Even if he's overweight, it should fit right. And he looks dumpy. It just tells to me that he does not pay attention to detail.
Yeah. No, that's a really good point, especially the boxy suit thing. Like, how do you not notice that your suit doesn't fit or it's like 3 sizes too big?
I don't know, but
You know?
we're beyond like, the junior high school dance days, right?
Yeah,
And so you
exactly.
need to know, okay, is this guy really gonna, is he, Tony Robbins has a great theory on this that I've read, and it goes like this. It goes, people will gravitate towards people who are like them or who they want to be. And you always have to think about that when you're working with investors. Your investors, all they care about is you having a relationship with them. That's it. How's things going? I have a guy who has a significant amount of money in here. You would never know it. But I always treat him with dignity and respect.
And how are you, how are you transitioning them from like meeting at the Y on the board to getting them to trust
Here's
you
what
over
we do.
time?
You've seen these. I write letters, and those letters talk about what I'm feeling at that time about the market.
Yeah.
Okay. There's
and they're
one,
great. I get the emails too. Yeah.
You can download. I haven't released this year's yet, or at least compliance has, but there's one they can get by going to thedandrewletter.com, and you can read it. And people say, "I like it," because that is you and your voice talking to them. The way I talk to them is if I'm talking in those letters, is if I'm talking to you right now across the table at a Starbucks, or in this very 105-degree hot thing. Another thing I like to do too is to always talk about what's going on. Hey, we just closed this deal. This is great. Just keep on top of them. Keep on top of them. And then the last thing I do too is every once in a while, and this is something I would host what we call some sort of like a giveaway, like a cocktail mix or something. So they come to our office, right? Now we've done this more with Mexican families in Vegas because they're underserved and they have a lot of money. So we actually have someone in our office who speaks Spanish, and we'll have like a meet and greet, and they'll launch with something. And we have everything put together that has been translated professionally into Spanish.
Oh, that's great.
That they could understand. So again, we're meeting. I might not speak Spanish, but Nate over there does, and I trust him to say proper things.
Totally.
Go to hell San Diego, but things like that. But when you have these meetings and you bring people over, they want to see you. They're like, this is great. I've actually brought busloads of people here to see this, from one of my events. They're like, cool. It's real.
Yeah.
It's really, really real. And they like that, and just like text messages. If you know some guy that's like into like shady type of jokes, send him a shady joke every once in a while. There's always that guy.
No, that's good.
If you're like, somewhere, hey, I'm thinking, I took a picture of something the other day. It was like, some weird rim on a car or something. And I know this guy loves rims and stuff. He's from Southern California. And so I'm like, hey, look at this. This is, that's great. It's just keeping in contact because they want to know that you actually care beyond the dollar.
I love the caring beyond the dollar part. And what I want to ask you is where's the line between keeping good follow-up and staying top of mind and like being annoying and bothering people?
I don't, but this is private equity, right? So this is slow.
Yeah.
Once a quarter.
Okay.
I'd say maybe like, what I purposely have made a point of doing right now is I used to do a lot of like, fun back and forth with group texts with people and everything. Right now, I'll just be like, send an article from like Zero Hedge to an investor. Hey, I thought you might like this. Or hey, I met with this guy, your name came up, Paul, I hope all's going well. I'll be in Chicago, and there's going to be very, very prominent families there, and I'll just probably take a picture of like him and I and send it to another guy that I know that knows this guy. You know, just keeping it, together so that it shows that, hey, you are a spot here. You just don't show it when convenient.
Yes.
And I made it a personal goal at night. I'll basically at like 8 o'clock or something like that, when my wife's watching all those bad TV shows, I'll just start emailing like articles and follow-ups and stuff. And I dedicate the time to do that every other day. I do
Carve
that
it out into your schedule.
Yes, I start on Tuesdays. I do it on Tuesday. I do it on Thursday, and then I do it sometimes on Sundays because everybody opens their emails on Sundays.
I love that. That's really
yeah.
good
And
advice.
it's just hey, I know you like Mercedes too. Look at this G-Wagon my friend got. It's something stupid like that. You know what I mean?
But it's real and it connects with people.
It's real. It's like, look at this. He's got this Rentec flat, whatever, like all this stuff.
It's not like, oh, look at my company newsletter.
Yeah, no.
Or look at this recipe card.
No, nobody wants that. They're like, this is great. This is a real guy. He's approachable. I can get in touch with him. Really funny story. These investors, some of them know what they're getting into. Some of them don't. And the shortfalls is that they have access to you. And in 2003, I'll never forget this. There was an investor. The husband was very smart, but I don't think he really got along with his wife that well. And so the wife had a problem because Martha Stewart was indicted for insider trading and the stock went down like this. And they had the bulk of their daughter's college education in Martha Stewart online on the media, okay?
Wow.
And this is how you sort of frame the boundaries of the relationship here. And her name was Martha. And Martha was nice. She was the second wife to this guy who was a former Goldman partner, okay? And she called up and she said, hey, we need our money out of this deal. I said, what do you mean? She's like, well, and I knew the husband set her up for this, and I said, well, why? Why are you calling me? Well, Martha Stewart's stock is down, and I'm like, well, call Martha. Well, what do you mean? I don't have her number. Well, why are you calling me then? Yeah. Well, I have your number. Okay, but you understand, and I can say you can reference the docs, and I'm sure Harold will tell you this. However, this isn't a liquid investment. Right. This is not something you can, there's always going to be a way
you
that
can't call the cash due.
You can't call the cash due. There's no liquidity. And I said, just because you have my cell phone number doesn't necessarily mean that I'm going to be your bank account or your slush fund here because Martha did. So call Martha up.
Yeah.
And by the way, why did you invest in Martha anyway? And then they opened up a whole Pandora of questions she didn't want to answer, and it was fine. In the real case scenario, she had a significant amount of money into it, but then I could always say, if there was really an issue, I'd be like, hey, Oliver, I got an LP, and this is my favorite part of the business, the LP secondaries. Well, they have $250,000 in this deal, but I'll let you in. You can get $250,000 worth of value. It's probably worth $300 right now, but I'll sell it to you for $100,000.
Or 150.
Yeah, 150.
Right, exactly.
Yep. And now they're out. You're happy because now you have a 2.5x basis, right?
Yeah.
And so that's the sort of the deal making that goes on.
That's a great tip too.
But you don't want to do that, and the reason why it's so deep is because it's an inefficient business. Real estate is inefficient, right? Mm-hmm. It's not like Google where you're going to find an inefficiency, but you're like, hey, I'll scrap that up. And we do have money on the side sometimes for that kind of stuff because
people on deck.
Yeah. No, exactly. And it's a lot of fun.
That's
it's
cool.
just, but it's like, hey, there are always ways to do that when you structure the deals to provide some instance of liquidity, but that scorched the earth and I never want to talk to you again.
Yeah.
It's
totally.
like, okay, 250, you come in with 150, you're happy, you're getting a deal. You're sitting there like, oh my gosh, so if he's getting a 2x, that means I'm getting a 4x because I got in at 100.
Right.
And he has and people, it's easier to sell it that way, and that goes with part of the capital raising process.
Totally.
Always talk to people. You don't have to know your deals. You just have to know and talk to people. Really, you just have to talk to people. Yeah, you're going to have to know some stuff and everything, but when you first start talking to people, remember, if you're raising capital, you put that money into other people's deals who are smarter and more experienced than you, and you won't get hurt, and that's how you build a track record. Don't try to be the hero who's going to go out there and do all this stuff yourself and rehabilitate 200 units because you will die, your wife will hate you. I've seen this happen before. It's like, they're in this deal, they're not spending time with their wives, they're managing it themselves because they overpaid for it.
It's driving everybody nuts.
Yeah, I always have a joke at my events. I say, how many people here manage their own multifamilies? Proudly.
Yeah.
I'm like, really?
Yeah.
I said, is that your wife?
Yeah.
I want you to turn to your wife and tell her you don't love her enough to pay 5% for a management fee. What do you mean? I love my wife. There's only 2 reasons why you don't have a management company. You're overpaid,
Yeah.
or you don't like your family. That's just really it. It is.
That's funny.
And if you don't like them now, they won't like you by the end of it.
Right.
And that's the way you got to look at it. But you don't want to go out there and be the hero. Be the person who provides solutions. Be the banker. Don't be the landlord. If I can urge you guys to do anything. And that's exactly what I've been telling Sam and you guys, how we've been doing this and you guys to do that. Because in this way, if anything goes wrong, right, it's not just you, everything else. And there's a lot more problems, I think, that people see going into things as being an operator with no experience. And that's where a lot of problems happen.
And so the rough framework for raising money is
get social.
Connect.
Yes,
right?
Connect with people.
Be
Go out of
real.
your comfort. Be real. Be very
quarterly event in person.
Quarterly event, or just or a letter.
And a letter
that you don't have to write
quarterly or monthly.
For us, we do it semi-monthly because we've been a little slow. We've been very purposeful with the deals that we're getting into. But that doesn't necessarily mean that I'm not going to write a letter, to them telling about the market, where I see it, my views on liquidity. We actually do have a newsletter called Alternative Access. We just released it. I'm not plugging it, but it's another way, to get that hand newsletter. It's like, oh, Sal wrote this article and some other things too. But they really look for the letters that I write that are sort of tombs, and you don't have to do that. Today, with the internet, you can outsource all of that stuff and say, I need to write a letter to my investors to tell me what it is, and I want it to look like this, and I want to handle all of this, and you can hire someone for $200 to write that letter on Upwork.com. Financial writers. Don't hire your sister-in-law to do it for free because she's cheap, because she'll never pay attention to it. You'll hate her. She'll hate you because she has to do it for free. And then you're going to feel guilty because it's going to be 2 months before you get it when you wanted to have it a week before the event that you're going to with the Lions Club or, whatever.
And the example letter that you referenced was thedandrewletter.com.
Yep, thedandrewletter.com. So you can download it. It's an opt-in because we got to know who's in there. But there's no sales or anything on that. It's just, this is what you want to show to you. This is how you want to speak to your investors. Use it as a conversation starter when you talk to those investors. You can just plagiarize it. Say anything. What do you think about interest rates?
Borrow it.
Yeah, you can borrow it. Yeah, okay. I forget who I'm talking to. Sam. Anyway, but yeah, you can borrow those ideas to use that at the water cooler to talk to these people about it. What do you think about this? What do you think? Because I'll tell you what everybody's really worried about right now is low interest rates. And I think, and again, this is something I say that I go out there and I throw it on the table. I say, I don't think rates are going to increase in my lifetime or yours. What do you mean? I just grabbed their attention. Yeah. And now all of a sudden, we're building a relationship.
Yeah, that's good.
Yeah.
That's a good hook too. So the quarterly events, the emails, and then the texts in between of just
text.
Real stuff,
Same
jokes,
crap I send to you guys.
Stuff you like, stuff they like.
Yeah. Stuff like, but it's of interest to them.
Right.
Hey, I know I rowed in college, and I know one of our investors, they're rowing right now. They're trying out for the national team, and I would always say, hey, I followed, Stacy, is going through it. She did a really good job, and she's in this boat with this other girl I know and everything. Just building that that commonality, bring it together and use it to your advantage. I think Joe Polish wrote a great book on it. It's how to use everything I'm going to slaughter this, and I'm sure I'm going to be shamed for this, but he wrote a great book on how to use everything you can to your advantage. And I can't remember what it is. But if even if you have something in common, whether it's boats or football or something like that, just do it. You don't have to hang out with them all the time. I don't like.
And I think the important part of it too was carving that time into your schedule so that you actually do it. So that it's not just random.
Right. So if you're like a realtor, for example, you're always going to be on the phone. You're doing the calls. That's part of it. For me, I get buried a lot in minutia, that I have to do, that I'm responsible for. But I always carve out Tuesdays, Thursdays, and on the weekends, just firing off emails, or maybe like just with a video or a picture today. There's no excuse. Sometimes I'm in my car and I have a little magnetic thing, and I hang my phone on it, and I say, hey, I'm stuck in traffic. I just want to tell you, I got your email. I'm going to be in New York. Whenever you're going to be somewhere, I'm going to be in Chicago next week. I'd love to catch up with you. Let me know. Oh, yeah, of course. Yeah. Well, it's so funny because, we're going to see some game with the owner of the Chicago Cubs and stuff like that. But, you get to that level by starting out and connecting with people first.
And the reality is, even if they're not available, it's just the fact that you touched them and reached out and thought of them.
It's so important.
Yeah.
you have to treat these investors like they're your friends.
Yeah.
And you don't have to hang out with them all the time and everything. But just treat them with dignity. Don't walk in and say, hey, you're an ATM. I need money.
You got money? I need money. Let's do this.
Somehow, like, what's that, Step Brothers? Hey.
Yeah, totally.
Let's enterprise, right?
And then, okay, so then at the point in time when it's time to ask for the money.
So here's what you have to do.
Okay.
You seed it and feel, okay, we're going to be doing a capital call on this project.
Okay.
This project, we're calling the capital. You will have for tranche 1, and you always put in the first few tranches all the goodies. You don't do that in the end.
And hold on, not to cut you off there, but for the people that don't know, what is a tranche?
A tranche is basically like different segments in
like
the same
phase 1,
investment.
phase 2,
yeah,
phase
exactly.
3. Yeah.
So a tranche would be, okay, if you're coming in, you're getting an equity kicker and an income kicker. But you have to come in by this date.
Got it.
Your tranche 1, done.
So it's almost like a fast action bonus.
It's a fast action bonus.
Okay.
All right, if Sam comes in, he's not getting the equity kicker. So when we refinance, he doesn't get that. You do.
Because I'm in tranche 1.
Because you're in tranche 1. Tranche 2, he's a little slow, Maybe he needs to run a little more. I don't know, but he's got to get a little faster with it.
Yeah.
And then tranche 3, you're lucky if just to participate.
Right.
So you water down the incentives. What you're going to find is you're going to see a lot of people who are going to be like, well, I had this life event. Somebody almost had cancer or something. And I'll tell you that you do this once, but you have to really frame the boundaries of the relationship. You can't just go in there and say, well, it's tranche 3, but I'm going to give you tranche 1 anyway. Unless they're like big guys and you trust them and stuff, be like, I'm sorry, I can't. I have to put this in front of the investment committee, and I can't answer why you're investment committee. I have to put this in front of the investment committee, which is Nate, for this.
What's up, Nate?
I have to put it in front of the investment committee why you're coming in 2 weeks late for tranche 1 when that already closed. And then they'll say, and then you can use that as negotiation and be like, well, instead of 50,000, we'll let you in for 100,000. Oh, by the way, did you know that somebody abandoned their tranche 1 spot? I can give you that tranche 1 spot. There's still $100,000 available in that slot.
Got it.
Now, when you're starting out, here's the secret. You give them all the same because you just write the docs once. And if tranche 3 gets the same, oh, shame on me. Well, you won, I lost. But you have to make sure you're on top of them with it. When I call them, we text message. We use Google. You can do Google texting. I text from my own phone. It's a pain because we have so many of them, but we have texts. People respond to texts. People don't check emails all the time. We also do phone calls too as well. We use slide broadcast. Hey, just want to let you know, tranche 1 will be closing. And I always do this on Friday at 5 p.m. New York City time.
Got it. Very specific.
Very specific.
Yeah.
Specificity gets you funded, okay? It closes on Friday. 5 o'clock New York City time. I highlight it and bold it because when you put deadlines in, that's a negotiation, and it also allows you to communicate to your counterparties or this family here, for example, this is how much we can expect to bring in for this based off of how we're running our book right now.
Great. Love it.
Yeah, you call them up. Hey, we didn't get this. Hey, a person we know named Lori is always flustered. So, tying her down has always been hard. She sold her business. She's busy. But I'm like, Lori, I really want you in this. You know this. Can you please do me a favor? My hands are tied. If I can't get this in by Monday, the latest, I know you're very busy. Please do. Okay. Yeah. Just treat them very, very well. And say, this is a club deal. There's very sophisticated people here. They're not waiting.
We're all waiting. Yeah.
Yeah, we're all waiting.
Right.
Why? I'm sorry that your horse is sick or your dog died, but this is money.
So I love the timestamp. So then,
but you also have to. There's another side to this too, is that not all investors are going to be good investors for you, because I can't tell you how many people have come around and they're like, well, I got all this money and everything, but they don't respond and they're very flaky. You just say, look, I don't.
Or the opposite, they want to be all up in your business. They want to be all up in
that's another thing.
Right.
Hold that second, okay? Because that's another very, very important issue. But the thing here that you want to talk about, the most important part about this, I have investors who trust me to do what I say I'm going to do. If I can't trust you to follow instructions, to sign a simple e-document on your iPhone, we always use right signature, I don't want you as an investor. Now you've turned the tables, right? Now it's like, oh, I'm all rich and powerful.
Right.
Well, yeah, you can't come into my club now.
Yeah, now you don't qualify anymore.
Now you don't qualify because I can't trust you.
Right.
Okay? And I would always say something like, a lot of the investors, they always say, I trust Sal with my wallet. I don't know if I trust my wallet with you because you've not been able to perform in a way that I'm used to having other very successful, wealthy investors richer than you. And I don't really care about your move or your dog dying or anything like that. Are you going to step up your game and be a grown-up man and woman? Or maybe you should buy $40,000 impoverished property in middle America.
Yeah. What's better for you?
Yeah, it might be better for you because you're a little too busy.
It's the takeaway.
No. It's the takeaway. Yeah. There's a lot of people who are very used to getting what they want, and we have a timeline here. It's a courtesy that you're in this deal.
Right.
It sounds obnoxious, but where else are you going to find a Class A deal like this? Oh, I don't know. Well, it's not about you. It's about your kids. Mm-hmm. You're putting your kids' trust into this, right? Well, I haven't set up the trust yet. You have a week to set up the trust. You need a phone number? Here's a guy in New York to call. He'll get it done. It's like the liquor store. You might not have a shirt on, but it works and it's fast.
Yeah, exactly.
And then before you know it, it's great.
Yeah.
But yeah, you always have with the investors, they'll be like, and I see this a lot too, especially with doctors and dentists, because they'll look down on people who are not doctors and dentists. And I'll say, look, there's a reason why we don't use doctors and dentists, is because they always want to think that they're smarter than the rest. Just because you have a PhD in entomology or you've cured some sort of degenerative disease, that's great. But that doesn't necessarily mean you know real estate.
Right.
And that's a huge thing. Mm-hmm. And that's where a lot of people leave their egos at the door. They don't leave their egos at the door. You have doctors who come in and say, well, I want to have a say in this stuff. Okay. Well, here's a question for you, doctor. You're very good at what you do. You've cured sicknesses. However, what qualifies you to make decision-making? Here's a better way of putting it. How do I justify to my very wealthy investors that you have experience and are qualified to do something like this?
Yeah.
And then just shut up.
Mm-hmm. The overbearing people.
What's overbearing mean to you?
It means the people that want to be all
people,
up in the deal. They want to know everything all the time. They're blowing up your phone.
Yeah, you don't deal with them.
And how do you respectfully tell them to kick rocks?
I tell them that what you're asking for is something that we're not prepared to provide because this is a slow business. It's dirt. It's real estate. This isn't stocks. It sounds like you should be in something that trades. Maybe cryptocurrency, would be better for you. Right. However, this is a professional investment. You will have no say in it. It's completely passive. And there's people involved in this deal who are much more experienced than you are. And they do not want you having a voice in this deal. If you do not like that, then go somewhere else. Bitcoin. Right. If not, if you want to work with people who are very smart, established operators, you're welcome to join along. However, I don't want to kid you for a second that you're going to have a seat at the table when other people who are bringing in $500,000, they're going to want to know, why did you let this guy in with $25,000 in the first place? And second, why does he have a voice? Just because he's a doctor doesn't mean anything. Right. And unfortunately, a lot of guys like me, I can get along with that. And I know families who are very wealthy, medical families, but when you're working with these doctors, you got to put them in their place. If you've been a realtor for years, I have 20 years experience as a realtor. I know real estate better than you do.
And I think that confidence just comes from experience and just being able to be like, no. And it's the same way you could almost even flip it on them. Like, look, if I'm on the operating table and I need you to remove my appendix, I'm going to trust you that you know what you're doing. And I'm not going to be, oh no, move this over here, cut the incision a little lower or whatever.
There's one other thing.
That's your department.
This is a great example. So there's a good friend of mine out here is a plastic surgeon. And I helped him buy his surgery center. And it's nice. It was a $2 million center. And the story I use is, okay, just because, I helped you buy that surgery center, does that mean that I can start doing breast augmentations too?
Yeah. No.
Okay. It's the same thing.
I don't think so, Sal.
It's the same thing.
Right.
And the other thing too with the deadlines is that when you are talking to investors for the first time, make their spouse show up, especially if you're working with doctors and dentists. Because doctors have a great way of saying, well, I got to talk to my wife about it. Well, let's just even the course here. You spend the amount of time you do making life or death decisions every day, and now you have to talk to your wife about a $100,000 investment. What does she know about this deal that you don't? And why is she all of a sudden coming into this? Right?
Yeah.
Isn't she like 20 years younger than you? And okay, so why, and they're like, well, and I would never talk to an investor, especially a doctor and dentist, if they did not show up with their spouse, because I want to talk to both of them.
Right, at the same time.
At the same time, up front. And then this way there's no, I got to talk to my wife.
Right.
No, you don't give me that. You make life or death decisions. You graduate from medical school, residencies, and everything, and now you're telling me you cannot control your own finances? How did it get to this point? And it's usually because they don't understand something.
Right.
And that requires a little more talking.
Flush out the objection.
Flesh out the objections, exactly. What is it? And you know what it comes down to? Liquidity. And once you handle that liquidity thing, it's a little smoother than that.
Yeah. And then just to put a pretty little bow on the raising money thing. So the new deal, you have a new deal. You send out the email and the letter.
Tear sheet. You send out a tear sheet. When you have the deal, you send out the tear sheet. Tranche one, 2 weeks.
Then you're pounding the phones to follow up with everybody.
You're
texting.
following up the phones. You're texting them with Google Text.
You're putting a deadline on it.
You're putting a deadline on it. You have to have the documents already done and everything. So you send it out to them. I always use DocuSign. Because there's always going to be friction. Because somebody has an inkjet HP printer scanner at home, and it ran out of ink, they're not going to print out a 90-page document, right? You make it very easy, and with iPhones today, especially DocuSign, I'm not saying it's like anything. It's like check,
click,
it's all filled in,
right.
done, and then you have a permanent record of anything that happened and where that is, and you don't have to worry about chasing that guy down. Because the less friction you remove from getting the money from them, the faster you're going to get it. And that's the whole point. So it'll take 2 seconds. Lori, I know you're on your farm. If you have cell phone service, it'll take 2 seconds. And then on the front page of the email, you always put the wiring instructions. Never accept checks. I actually can't believe I have to say this. Never accept checks. You always put the wiring instructions on the first page. Here is the deal. Here it is right here in the email. We put this on the front page on this email. Print out this email and bring it to the bank because it has the wiring instructions. Make it easy for them because you don't want them to say, well, I couldn't find the wiring. Oh, this. Everybody's going to have an excuse, especially when they're getting upset and it's coming down to the deadline. Everything becomes my fault at that point, and you have to make sure that you make it easy for them to be able to grease the chute, as we say, so that there's less friction.
Yeah.
And then you just continue on. You call them, and then you send them updates and be like, oh my gosh, we are oversubscribed. And it's true for this. We're oversubscribed. Well, I mean, we're not going to have a tranche 3 anymore. We're going to have a tranche 2, and that's it. And we only have about $500,000 left for tranche 2.
Get it while it's hot.
Get it while it's hot.
Yeah.
Otherwise, it's closed.
Yeah.
It's up to them. You have to have a sense of urgency with them, and unfortunately, that's something that the financial services industries have never really put into this, is a sense of urgency when talking to investors, because most investors they talk to are, they're professional investors, but when you're dealing with retail investors, which are mom and pop investors, anyone I would say, less than 50 million in assets, those are retail guys. You're going to want to, have to, really put the hammer down as far as deadlines and defining the boundaries of the relationship, because it's your reputation at the end of the day with a family, a developer or something. And if you want to do another deal with them in the future, this is what you have to do.
Love it. Great tips on raising money. Really cool project you got going on here.
Thank you.
So the exit strategy is just
7 years.
7 years.
Yeah, that's it. Yeah.
14 year, and then maybe you guys will see what happens then.
Yeah. 14 years is not a lot of time.
Right, exactly.
We'll see, but collecting checks for, we have money in this deal, but I mean, people can get into this deal, a deal like this without putting their money into it, as long as they structure it correctly.
Cool, man.
And they're upfront with their investors.
And if people are interested in learning more about what you're doing and what investments you have coming up, is there...
The Dan Drew Letter.
Okay.
Go to the dandrewletter.com, thedandrewletter.com, and we'll send you some information, some of my propaganda, the letters and stuff.
Cool.
And if you're interested in raising money, you might want to model what I'm doing off of that with the templates and the letters. If you're interested in co-investing alongside of us, that's another discussion we can have too as well.
Great. So the dandrewletter.com, that's where they get all that info?
That's where it is. That's where the gospel is.
Very cool. Appreciate it. If you liked what you heard today, leave us a comment, hit the like button, subscribe, and really appreciate you having us out here.
Thank you so much.
Looking at this
I'm like
badass
soaked
project
right now. It's like,
now we can get out of this sauna, go relax, maybe have a couple more beers.
Absolutely.
And thanks a lot, Sal.
Thank
really
you very
appreciate
much,
it,
man. I
Cheers.
appreciate it, bro. Thank you, Booby.